Our advice is to trim traditional private real estate and add listed specialty sectors. This is the most efficient and low cost way to access these specialty sectors at scale. And we've helped clients do this in the past. It's been a success all around.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Adrianna Giesey, Senior Portfolio Manager at Russell Investments. Adrianna is with me to share how Russell is providing investors with access to the modern economy by incorporating a specialty sector REIT strategy. Adrianna, welcome to the podcast.
Hi, Sarah. Thanks so much for having me.
To start with, I wanted to ask you about the Russell Investments house view in terms of how commercial real estate is positioned within this current environment where we're seeing so much uncertainty and volatility on a daily basis.
Sure. The U.S. real estate market is on a path to recovery, but there's still a lot of uncertainty around what that recovery will look like. Fundamentals are generally improving, but do vary by sector. So you have vacancy rates, sectors like multifamily and retail that have been trending down. In the industrial sector, vacancy has leveled off near its historical average, but this is after experiencing a pretty big surge in demand that was then followed on by a supply boom during COVID. So it's taken some time for that sector to return to those pre-COVID norms. We do expect to see leasing pick up there in the next couple of years as well. The office sector remains slow, but it's finally showing some signs of improvement. Vacancy rates are still high, but they did stabilize in mid-year 2024 and even declined in the fourth quarter. If we look at absorption, that's still lower than pre-pandemic levels, but it's encouraging to finally see some positive trends in that sector. Overall, demand is pretty solid in most of the property sectors, but not all sectors are performing at their peak yet. We would expect overall demand to normalize somewhere in the 1 to 1.5% of inventory range, and that's going to help drive growth for the overall real estate sector. Now, if we look to the supply side of the equation, construction starts have fallen meaningfully. They're down nearly 80% since mid-2022. Just to put that in perspective, that brings us somewhere back to the levels we haven't seen since 2012. So what that tells us now, that sharp decline means that we can be fairly certain what the supply levels are going to look like over the next, call it 2 to 3 years. So we don't expect to see much growth in the supply as a percentage of new stock until maybe 2027. Finally, just a point on valuations. Certainly they're more reasonable now and finally seem to have found some sort of bottom here. All that caveat that assuming that we don't see a meaningful increase in long-term interest rates from here.
That was really useful. And can you share a little bit about how Russell has traditionally approached private and listed real estate investment? Have you been more active in one section over the other?
From a total portfolio level, real estate has historically been 10 to 15% of a portfolio. Within that allocation, combining public and private, once you get listed to be above 20 to 25%, you start introducing more financial equity market risk. So we typically have seen listed fall into that 10 to 20% allocation within the real estate allocation. But both segments definitely play a role and are complementary to each other at the total portfolio level. You do see higher volatility in listed real estate, but we would say that also creates opportunity to invest in mispriced securities. On the private side, liquidity can be fleeting, as we've seen in this most recent cycle. There can be cues to get out of investments, which is why we like to combine the two. From an asset allocation perspective, our internal team has really done a great job understanding the benefits of combining both public and private and including private real estate in our asset allocation framework. And Russell has a long history of doing this. Not to get too far into the weeds here, but just at a high level, the framework suggests that over the long term, the return differences between REITs and core private real estate are primarily driven by two factors: leverage and sector composition. But over the shorter term, more cyclical periods, those differences are really driven more by factors like price to net asset value.
Would you say that your approach has been influenced at all in tandem with the long-term technological and demographic changes that we've been seeing?
Yeah, we've seen a pretty big shift in the composition of the real estate market over the past decade. Core sectors like industrial, apartments, office, retail, those used to make up a majority of the listed market, but we've seen that shift both through the emergence of new sectors like data centers, single family renters, as well as just the growth within this segment of the market as has experienced as a whole. These specialty sectors, as we refer to them, they've really been benefiting from those secular tailwinds you mentioned, now account for almost two-thirds of the US index weight. If we look at the NCREIF Odyssey Index as a proxy for private real estate, it's still dominated by those core property sectors and only has about 9% in those specialty sectors. Just generally speaking, the private markets do tend to follow the public markets in terms of return and also property composition. So this allocation also has grown pretty meaningfully over the last 10 years, but it's going to take time to build scale since some of those funds are so big. So all that to say that the private markets are moving in the right direction, but we like the REIT market to gain access to the specialty sectors at scale, which is a nice complement to a core real estate portfolio.
What about performance? How would you compare the performance of modern economy sectors with more traditional core sectors? And what do you see when you look out for the next few years?
Yeah, so there's been a wide divergence in performance for the specialty sectors over the last several years. Again, as I mentioned, further to the growing share of these sectors and the emergence of new sectors that we just talked about, the growth in market share is also attributable to strong performance as well. These secular tailwinds continue to be supported by healthy fundamentals, strong supply demand dynamics, and we expect these modern economy sectors to see stronger cash flow growth over the medium term. I'm sure you're going to ask me why that is, so let me give you a couple examples. On the technological side, we have trends like AI and work from home driving demand for data centers. The AI opportunity set is pretty broad and it's a big driver of demand for data center space. Leasing demand from AI has been very strong and continues to grow. There's also the issue of power constraints, which is limiting new supply growth. And that's really giving existing landlords strong pricing power at the moment. If we look at demographics, we could start with the aging population in the US and the lack of senior housing supply. That over 80 population segment of the market is going to increase by over 40% by 2030. So, a pretty steep acceleration in demand for senior housing over the next 5 years. Construction of senior housing essentially shut down during COVID, leaving us with a lack of senior housing supply in this country. You couple that with rising demand, and that creates a pretty attractive opportunity here. Now, at a completely different stage of life, we're seeing a bigger appetite for single family rental housing by millennials. They want more space as they get married, have kids, and also need room for a home office with this hybrid work from home format. The other big driver here is housing affordability, which is at an all time low and is a huge headwind. Demand for single family housing is pretty sticky. So once people are in a house raising a family, they don't necessarily want to move. So turnover is fairly low, and the opportunity to increase rents when they roll is pretty high. It's pretty similar to what we see in storage. Tenants are typically pretty complacent once they rent a storage unit, and it takes a lot for them to move out completely. So again, sticky demand and the ability to raise rents.
So, what's the best way for investors to gain access to modern economy sectors while reducing exposure to legacy sectors that may no longer be appealing?
Our advice is to trim traditional private real estate and add listed specialty sectors. This is the most efficient and low cost way to access these specialty sectors at scale. And we've helped clients do this in the past. It's been a success all around.
And while there are clear benefits to investing in specialty listed REITs, there's obviously still a strong case for private real estate. Should an ideal portfolio include both public and private, and what sort of balance would you say is preferable?
Yes, for two primary reasons. 100% private portfolio is going to miss opportunities in sectors where listed is the best institutional quality platform. It's also going to prohibit investors from taking advantage of the pricing arbitrage that occurs between public and private markets at different points in the cycle. A lot of institutional investors moved out of REITs to reduce volatility, But again, we're reminded of the liquidity challenges in the private market over this most recent cycle. Even in the open ended funds are still working through their redemption queues. So we think a combination of listed and private allows investors to gain exposure to preferred sectors in the most efficient and least expensive way. As for what's the optimal mix, it really depends on clients' tolerance for volatility. On average, we've typically seen anywhere from 10 to 20% of a total real estate portfolio invested in listed real estate.
Our listeners would like to know about Russell's approach in terms of using investment managers. What are some of the key requirements you use in selecting managers and how are they monitored?
Russell Investments is well known for our manager research. It's been the backbone of our advisory business and how we build investment products. And that extends into real estate and how we build custom solutions for our clients. There are a couple themes to keep in mind to help frame our methodology. First is access and transparency, not only to the key decision makers at the manager level, but also to the portfolios. Next point I'll touch on is the breadth of coverage for both listed and unlisted. This is really an important point because it helps give us perspective to choose managers who are constantly outperforming. It gives us a way also to differentiate among the opportunity set of managers and also their investment proposition. If we get down to our process, we use both qualitative and quantitative inputs. Not surprisingly, we start with people. Real estate is a capital intensive business, and we are entrusting these managers to allocate on our clients' behalf. So, strength of organization and quality of the investment staff are crucial. Are they insightful? Are they properly incentivized? Next, we look at their process. What sets this manager apart from the others? Is this strategy unique? Is the process repeatable? Risk management, things like that. If we look on the quant side of the equation, what are we investing in and why? What is the investment rationale? If you get all that, then the performance should follow. I will add here that within private real estate, the one difference there is that we spend more time on the makeup of the portfolio. On the listed side, holdings are fluid. Active managers are constantly making small adjustments to the portfolio. While on the private side, it takes longer to reposition the portfolio. So we spend more time evaluating portfolios at the asset level as a part of our underwriting.
Would you be able to share an example of how Russell has worked with a client to adjust their portfolio to gain an optimal exposure to specialty sector REITs and what the results look like?
Sure. Russell is known for taking customized approaches to help our clients achieve their investment goals. Probably the best example I can think of is when we developed a specialty sector's separate account strategy to complement one of our clients' private real estate portfolios. Now, there were several moving parts here, but we worked with the clients to first identify the opportunity set that best fit their needs. We worked with FTSE to build a custom published index to use as a benchmark. And then finally, we had to take a real close look at our highest conviction sub advisors to see which ones we thought had the best capabilities for this assignment. We settled on a strategy that targeted these modern economy sectors, driven by a lot of those technological and demographic themes we've been talking about. And at the end of the day, really, as a firm, it's our broad capabilities and knowledge of the listed REIT manager universe that allowed us to move from concept to implementation in a matter of months. Now, how has that fund performed as far as results go? Performance has aligned within our expectations so far. When I say align, I mean that this index has outperformed the broadly diversified global developed index over the past year, as well as the underlying sub-advisors have also been very successful at generating consistent excess returns since inception. The underlying sub-advisors have also been very successful at generating consistent excess returns since inception. So we've been really happy with the results so far.
Do you see this type of portfolio adjustment as mainly a specialized approach, or do you think it would be advantageous for a broader set of investment clients?
Yes, this approach should definitely be utilized more broadly. We've seen a number of pension funds with core private allocations that we think would really benefit from accessing these sectors at scale as a way to complement their current real estate portfolios.
Great. And we've touched on a lot of topics today, but anything else that you'd like to share on how Russell is approaching real estate investment today?
I would just add here and highlight our ability to use multi-manager and multi-strategy to find and give our clients best-in-class exposure across asset classes. It's the foundation of our business model. We continue to be successful, especially in real estate, because the properties owned by the underlying managers will go through cycles, and those cycles don't always match up. So we get better diversified returns with a multi-manager, multi-strategy approach. Even our flagship core private open-end fund of funds, it owns over 2,000 properties. So investors can achieve that broad exposure with sort of a one-stop shopping experience.
Adrianna, thanks so much for spending time with the REIT Report today.
Thank you so much, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.